Welcome back to the Tax Free Millionaire Blueprint. So, today we're going to get into what the difference is between a LLC and an S Corp and which one pays you more. So, if your business is making over $60,000 in net profit right now, and you are still taxed by the IRS as a LLC, single member LLC, then it's a very high probability that you are overpaying in taxes right now by $5,000, $15,000 every single year in unnecessary taxes. So most business owners think that forming an LLC is all they need to do for tax protection. But an LLC is a legal entity, not a tax strategy. So in this video, I'm going to break down the exact mathematical break even point where switching your LLC to an S corporation tax status gives and saves you thousands. How to split your income legally, and the major mistakes that trigger the IRS audits. So, to understand why an S Corp saves you money, you must understand how your default LLC is currently costing you money. Okay, so when you create a single member LLC, the IRS treats you as a pass through entity, taxed as a sole proprietorship. That means every single dollar of the profit of your business makes flows into your personal tax returns. So now that you pay ordinary income tax on that money, that's normal. But here's where the trap comes in. You also get hit with a 15.3% self employment tax on the 100% of your net earnings. So that 15.3% covers Social Security and Medicare. When you worked a traditional W-2 job, your employer paid half, 7.65%, and you paid half, 7.65%. But an LLC owner, you are both the employee and the employer. That means you pay the entire 15.3% yourself on every dollar up to Social Security wage limit and 2.9% on everything above it. Okay, so if your LLC nets $100,000 profit, you are paying over $15,000 in self-employment taxes your before you even pay a single dollar of income tax. So before you pay income tax, you're already charged 15.3% self-employment taxes. So, how do we fix this? That's where the S corporation comes in. The S corporation tax election is what is going to save you in this situation. So, first, a quick clarification of what an S corp is. Not a new business entity. You have to go register from scratch. It's simply a tax classification. A switch you flip with the IRS by forming Form 2553. Okay, so it's basically you don't have to go and change um, your whole entity. You can elect to file as an S corp. So when you make this election, the IRS now views you as a owner employee of your corporation. This allows you to split your business profits into two distinct buckets. So you have bucket number one, a reasonable salary, like you were getting paid with a W 2. You put yourself on the official payroll and pay yourself a fair salary for the work you do. On this salary, you pay traditional payroll taxes. 15.3% split between your business and you. Bucket number 2 is going to be the shareholder distribution. So whatever profit is left over in the business after paying your salary, after paying yourself a salary, and expenses can be pulled out of owner distributions. So, and here's the magic formula that I'm going to tell you. Shareholder distributions are not taxable, and they're not subject to 15.3% of self-employment tax. You can still pay a standard income tax on distributions, a standard income tax, not subject to the 15.3% self-employment tax. But you completely eliminate the 15.3% self-employment tax by doing this. And so you don't have a FICA penalty on that portion. So when should you actually make the switch? So you're running your business as an LLC and you find out that you have an option to form or elect your business as an S Corp. Basically, the general rule of thumb that's used by tax strategists is when your business generates a consistent net profit of $60,000 to $80,000 per year. Below $50,000, the administrative cost of running an S Corp outweighs the savings. So, but let's run the numbers here. $100,000 in net profit. So you can see the math. Let's see the math in action. So as a default LLC, $100,000 net profit, you pay roughly $15,000 in self-employment taxes. With the S Corp election, let's say a reasonable salary for your role is $50,000, leaving $50,000 as distributions. So you pay payroll taxes only on the $50,000 salary, which equals about $7,650. So the remaining $50,000 as distribution incurs $0 in self-employment tax. So that's an immediate $7,650 tax savings. Okay, on the exact $100,000 that we discussed earlier on that revenue. So even after accounting for $1,500 to $2,500 added in compliance taxes, in compliance costs for the taxes like payroll software, corporate filing fees, you are still walking away with over $5,000 savings in taxes and pure profit in your pocket every single year, just by electing as an S Corp. Now, before you go and run to file your paperwork tomorrow, you need to understand the golden rule of the S Corp. The IRS reasonable compensation requirement. So you cannot net $150,000 and pay yourself a salary of $10,000 and take $140,000 as tax-free distribution. The IRS knows this trick, and doing that is a guaranteed fast track to get you audited. So the IRS requires owner employees to pay themselves A reasonable keyword being reasonable, a reasonable salary based on what it will cost to hire someone else to do the job in your geographic area. So to determine your reasonable compensation number, consider these are the things that you want to make sure you consider, because there's some people out there who would try this and the IRS is on to those individuals. So, what are the industry salary benchmarks for your specific duties? How many hours per week do you work in the business? What is your level of technical expertise and experience? So, what is the overall financial health of your company? So, documenting how you derived at your salary using the market data or official wage reports provides a bulletproof defense for the IRS regarding any type of audit if it ever raises questions. Okay, so if you determine that the S Corp election makes sense for your business, the timing is everything. Okay, so to take advantage of an S Corp status for the current year, you must file the form 2553. You must file form 2553 no later than March 15th or 2 months and 15 days from the start of the tax year. So there's a specific time that you need to file for an S Corp for the year. So you have to pay attention or have your tax strategist basically have the timing correct for you so that you know that you are in the right time frame to even pursue a S Corp at that specific time. Because if you miss the deadline, if you miss the March 15th deadline, the IRS provides a late election relief under Revenue Procedure 2013 30 if you have a reasonable cause for missing the cutoff. If you are forming a brand new LLC today, you have 75 days from your formation to submit the form and have it backdated to day one. So let's summarize. If your net profit is $100,000, if your net profit is under $50,000, keep it simple and stick with your LLC. But if you're making $60,000 to $80,000 threshold, and this is consistently, making an S Corp election is one of the fastest way for you to save taxes and most effective ways to lower your tax bill and build long-term business wealth. So, if you found value in this video, in this breakdown, hit the like button and subscribe to the channel and drop your tax questions in the comments because I would love to hear them. I would love to answer questions for you. If you want to get a copy of my free business health evaluation for your business, the link will be at the top and also in the description. I will see you in the next video.